Okay, let's unpack this. Personal finance, financial literacy. It can feel like trying to drink from a fire hose, right? Just so much information, so many conflicting ideas out there.
Oh, definitely. You might think you need weeks, maybe even months, just to, get a handle on the basics.
And you're not wrong. The source material for this deep dive, it was a really comprehensive financial literacy course, and it took the person who summarized it weeks. I mean, they ended up with 109 pages of notes.
Wow. That is serious dedication.
Yeah.
But that's precisely why we're here today.
Exactly.
Our mission is to take that huge effort, that's like, 25 to 30 hours of deep learning time, and sort of distill it down for you.
Yeah.
We're pulling out the absolute most important foundational knowledge, the core insights from that mountain of material, so you can get well-informed, quickly.
Right. Because the course, it covered a surprising amount, 16 units. Everything from setting a budget, understanding loans and credit.
Investing scams?
Yeah, investing for the future, protecting yourself from scams, even navigating big purchases like cars and houses. It was all in there.
So consider this your essential shortcut. This deep dive is custom tailored for you based on the material you shared with us. We're going to guide you through the key areas.
Highlight the surprising nuggets, hopefully give you some real aha moments along the way. Ready to jump in?
Absolutely. Let's start right at the beginning, the absolute bedrock of personal finance. Budgeting and saving.
Okay, budgeting. We hear that word, maybe we immediately think restriction, right? But the source defines it really simply. It's just a plan to manage your money.
Exactly. It's really about tracking what comes in, understanding where it goes, and then consciously deciding what you'll set aside. Think of it less as a cage.
And more like a roadmap for your income.
Yeah, a roadmap. That framing helps. And the source presents a really popular starting point for building that roadmap. The 50-30-20 rule.
Ah, yes, the classic. So this rule suggests allocating your after-tax income like this. 50% for needs, 30% for wants, and 20% for savings.
Breaking that down. Needs are, the essentials. Housing, utilities, groceries, transport, necessary insurance, things you have to pay for.
Right. And wants are the flexible expenses, things that improve your quality of life but aren't strictly necessary, like dining out, entertainment, hobbies, those subscriptions maybe.
Exactly. And that crucial 20%, that's dedicated to saving. For your emergency fund, bigger purchases, and future investments, including retirement.
Okay, so the material included an example budget analysis, someone with a $3,000 after-tax income. Their breakdown was 59% for needs,
Okay.
27% for wants, and only about 14%, 14.17% actually, for savings.
Okay, so right away you see how the 50-30-20 rule acts as a kind of diagnostic tool.
Yeah.
That example budget was over on needs and, critically, under on savings, which immediately makes you ask, how do you shift those percentages to hit the target?
Well, the source offers some really practical, actionable tips for chipping away at that needs category, which often feels kind of fixed,
Like simply calling your utility or internet provider.
It sounds almost too simple, doesn't it? But the source emphasizes that these companies, they want to keep you as a customer.
Right. So sometimes just asking about better plans or maybe discounts they might offer, that can result in savings that lower those essential bills.
And groceries. That's a huge one for so many people. Beyond just shopping around or looking for sales, the source introduced a concept that, while simple, it can fundamentally change how you shop, per unit pricing.
This is brilliant, and something I admit I often overlook, too. It's about looking past the sticker price, right? And figuring out the cost per standard unit, per ounce, per pound, maybe even per, like a single laundry detergent pod.
Exactly. Sometimes the bigger package looks like the better deal, but when you compare the per unit price, maybe the smaller one or a different brand entirely is actually cheaper.
And those little savings, applied consistently to something you buy every week, they really add up over time, dramatically.
And the key insight here is that those savings aren't just loose change, they're actual dollars you can intentionally redirect.
Right. Lowering your needs spending is one of the most direct ways to boost that crucial 20% savings target.
Absolutely. The 50-30-20 rule isn't rigid, it's flexible, but it's a fantastic audit tool. Lets you see where your money's actually going compared to where you want it to go.
Okay, speaking of savings, the material was crystal clear on the absolute top priority, the foundational savings goal, the emergency fund.
This cannot be stressed enough. The strong recommendation is to save 3 to 6 months of your living expenses.
Right. So going back to that example budget where needs were $1,500 per month, that means having $4,500 to maybe $9,000 sitting in an accessible account.
And the reason the source emphasizes this so strongly is that life is just unpredictable.
Yeah. Job loss, unexpected medical bills for you, or maybe a family member, a major car repair. This fund is your safety net.
It's specifically not for discretionary spending or investments. It's there so you can cover your essential bills without going into debt if, a major unexpected event hits.
And once that emergency fund is solid, meaning you have those 3-6 months of living expenses saved, then you look at saving for other goals.
Right. That could be a down payment on a car or a house.
Or, importantly, long-term investments for retirement. And as the source notes, saving for a house can kind of serve a dual purpose, right? It could be a long-term investment, too.
Yeah, good point. Oh, and a practical pro tip from the source that I really liked, it makes saving feel more tangible. Create separate savings accounts for different goals.
Oh, yeah. Like what?
Like one for that laptop you want, one for the car down payment, maybe one for, I don't know, a future big trip, a yacht even.
Okay, maybe start smaller than a yacht. But yeah, seeing the money accumulate towards specific goals in dedicated accounts, that provides a lot of motivation.
Totally. And automating transfers from your paycheck into these accounts, highly recommended. Takes the decision-making out of it each month.
Good tip. And when you're looking at where to keep these savings, the source touches on savings accounts themselves. They offer interest, which is the bank paying you a little bit for holding your money.
But, as the source points out, the rates are typically pretty low, often in the low single digits. That example they gave, $100 earning $3 interest at 3%. It makes that clear.
Yeah, it's not huge growth. So when choosing an account, you need to consider things like minimum initial deposits, how easy it is to access the money, any potential fees, and of course, the interest rate itself.
Okay, let's shift gears a bit. From saving the money you have to how the world assesses your ability to handle money you borrow. We're talking about credit, and specifically, your credit score.
Right. The source uses the standard U.S.-Canada system as an example, where scores range from, 300 up to 850?
Yeah.
And at its core, it's a measure of how likely you are to repay borrowed money based on your past behavior. It's kind of your financial trustworthiness number.
A high score, say high 700s or 800s, signals you're low risk. And this is key because it means you're more likely to get approved for loans.
And, crucially, get lower interest rates, which saves you a lot of money over time.
Definitely. A score between 600, 700 is decent, but you might face slightly higher rates. And below 600, that makes it very difficult and expensive to borrow.
So how is the score actually calculated? The source breaks down the factors that make up that number, and the percentages are really important.
Okay.
The biggest piece, a full 35%, is your payment history. Paying your bills, credit cards, loans, mortgage on time, every time. That is the single most important factor, period.
Right. Makes sense. Then, and this was something that really stood out to me as a bit counterintuitive, the second biggest factor at 30% is credit utilization.
Yes, this one surprises a lot of people. Credit utilization is just the amount of credit you're using compared to your total available credit limit.
Okay.
And the source emphasizes that having a high credit limit is good, but using a large portion of it is bad for your score.
Huh.
So if you have a $10,000 credit limit and only carry a $100 balance, your utilization is 1%. That's excellent. If you're maxing out your cards, your score will suffer significantly.
Right. So it's not about not having credit. It's about managing how much of your available credit you actually use. Less is definitely more here.
Exactly. Length of credit history accounts for 15%. So a longer history of responsible credit use helps build trust.
Okay.
The types of credit you have, maybe a mix of credit cards and installment loans, makes up 10%. Though the source cautions, don't take on debt just to try and diversify your credit mix. That's not the point.
Got it. And the last 10%?
That's new credit. Opening several new credit accounts in a short period can lower your score slightly. Each application often results in what's called a hard inquiry on your credit report.
So the tip there is to space out applications if you can.
Exactly. Checking your own score, thankfully, is usually a soft inquiry and doesn't affect it at all.
Oh, and something the source highlights that often confuses people is what doesn't count towards your score.
Right. Your income level, your employment status, none of that has a direct impact on your credit score itself. It's purely a reflection of how you handle the credit you've been given.
So a key takeaway here for you, the listener, is to actually check your score.
Yeah.
Lots of free resources exist, like Credit Karma, or often your own bank provides it.
Definitely. And if your score isn't where you want it to be, the source provides the roadmap focus on those percentage factors, especially paying on time and keeping that utilization low.
Now let's talk about credit cards specifically. The source appropriately calls them a double-edged sword, and I think that's the perfect metaphor.
They absolutely can be. On the positive side, they are excellent tools for building credit, if used responsibly. They offer convenience, and many come with rewards programs, cash back, points for travel.
Yeah, the source mentions some people in the U.S. really leverage those points for significant savings on things like vacations.
Right. But the other edge of that sword is sharp and dangerous. Credit cards make it incredibly easy to overspend.
Uh-huh.
And if you don't pay the full balance by the statement's due date or the end of the grace period, that high APR annual percentage rate kicks in.
And those rates can be shocking. The source points out that Schumer's box summary you get with card offers lists the APR, often in the 20–28% range, sometimes even higher.
Yeah. And if you carry a balance and that interest starts compounding, credit card debt can spiral out of control really, really fast.
And some uses are particularly bad news. The source warns against things like balance transfers if the fees outweigh the interest savings.
And they are very direct about cash advances, basically. Just don't do it. The fees and interest rates are typically exorbitant right from day one.
So the key insight from the source on credit cards is discipline. Pay the full statement balance every single month before that grace period ends.
That's the magic formula. That way you avoid interest entirely while still benefiting from building credit and maybe earning some rewards.
It requires vigilance, but that's how you use the tool without getting cut by that sharp edge.
Exactly. Okay, shifting from managing current money and debt to thinking about the future, setting goals and planning your financial journey. The course introduces this idea of a money personality quiz. Are you a spender, balancer, saver, or investor?
It's a helpful way to understand your natural inclinations, isn't it? Spenders enjoy the present, but might need help with future security. Savers are great at accumulating, but might miss out on current enjoyment.
Balancers find a middle ground, but might struggle with decisive action. And investors are forward-looking, but could be overly focused on growth at the expense of stability or, current needs.
Understanding your type isn't about labeling yourself. It's about identifying tendencies you can work with.
Precisely. And knowing your tendencies helps frame your financial goals. The course really emphasizes setting goals using the SMART acronym.
This is a widely used framework for a reason. SMART stands for specific, measurable, achievable, realistic, and time-bound.
Right. So instead of a vague wish like, I want to be rich, a SMART financial goal would be something like a $100,000 down payment for a house by age 30.
Okay, yeah, you can measure your progress towards that. It should be genuinely achievable and realistic based on your income and expenses, and it has a clear deadline. That structure makes it possible to plan how to actually get there.
And the source also helps by categorizing goals by time frame. Short-term goals are typically less than a year away.
Like building that emergency fund, paying off small, high-interest debt, saving for a specific purchase like a new phone.
Right. And the strategy there is usually saving consistently from your income, often in a regular or maybe a high-yield savings account.
Okay. Then medium-term goals.
Those are 1 to 5 years out.
Yeah.
Saving for a car, funding a specific educational thing, or that house down payment. Here, you're still saving from income, but the source suggests you might consider low-risk investments.
Like high-yield savings accounts or fixed-term deposits, like CDs or GICs in some places.
Exactly, to potentially earn a bit more interest than a standard savings account.
And long-term goals. That's 5+ years away.
Yeah. Most notably, retirement, but also things like leaving a legacy or funding a child's future education. This is where investing becomes the primary engine for growth, using things like stocks, bonds, and those dedicated retirement accounts.
Okay, so once you've set these SMART goals across different time frames, the source provides a framework for building a comprehensive financial plan with 4 key components.
Right. Number 1, your budget, that foundational tracking of income and expenses we started with.
2, your savings plan, defining how much you're saving for each specific goal and prioritizing them.
3, your debt repayment plan. If you have debt, outlining your strategy for tackling it. The source notes there are different approaches you can research, like focusing on the highest interest debt first or the smallest balance first. The snowball versus avalanche method.
Okay, and 4.
Your investment plan, determining how much you're able to invest and where, aligned with your risk tolerance and those long-term goals.
Having those 4 pieces laid out gives you a really clear picture, doesn't it? Your current situation and how you plan to move forward. And speaking of the big picture, a key concept the source uses to measure overall financial health is net worth.
Ah, yes. This is simply calculated as your total assets minus your total liabilities, what you own versus what you owe.
And the source provides a very helpful step-by-step example. Someone might have $555,000 in assets like a house, car, savings, investments, maybe even jewelry,
Okay.
and $505,000 in liabilities, the mortgage, car loan, credit card debt, student loans. Their net worth would be $50,000.
Right. 555K minus 505K.
Mhm.
And the source points out it's very common, especially when you're younger and might have student loans or a mortgage that's larger than the current value of your assets, to actually have a negative net worth.
That's okay initially.
Yeah, it's common.
Mm.
But the goal is to see that number steadily become positive and grow over time. Calculating your own net worth periodically is a powerful way to track your financial progress beyond just your monthly budget.
Definitely encourage you, the listener, to try calculating your own.
Okay, let's pivot a bit and address loans and debt, and then how we protect ourselves from those curveballs life throws at us. Loans can feel intimidating because we hear horror stories.
For sure. But the source explains they are simply borrowing money with an agreement to pay it back, usually with interest and maybe some fees. They're a tool useful for significant purchases or sometimes necessary emergencies.
And when you apply for a loan, lenders are essentially assessing the risk that you won't pay them back. The source lists the things they look at: your income stability, your job history, your all-important credit score.
Your debt-to-income ratio, and for some loans, collateral and asset they can take if you default, like the house and a mortgage.
Exactly. And the source outlines two main types of loans you'll generally encounter. First, installment credit.
This is where you borrow a fixed sum and repay it in fixed payments over a set period, right? Like a car loan or mortgage.
Precisely. Generally considered lower risk and lower interest, but they can be less flexible.
Okay, and the other type?
Revolving credit. Credit cards are the most common example here. You have an approved credit limit, you can borrow up to that amount, and as you repay it, that credit line sort of replenishes.
More convenient for ongoing use, maybe, but significantly riskier and costlier because of those high APRs we talked about.
Hugely riskier. And the source specifically calls out payday loans as the extreme, really terrible end of this spectrum. They have truly predatory APRs that can be in the hundreds, even close to 1,000% sometimes. Just avoid them.
Wow. Okay. This leads into a crucial distinction the source makes: good debt versus bad debt.
Yeah, this is important. Good debt is typically viewed as an investment that builds future wealth or significantly improves your quality of life if you've researched it properly.
Like a mortgage on a home you can actually afford, or maybe student loans for education that genuinely increases your earning potential. It contributes to long-term stability.
Right. Bad debt, conversely, weakens your financial stability. It's borrowing money, often at high interest, to pay for things that don't appreciate in value or that you couldn't otherwise afford.
Misused credit cards and those payday loans are prime examples here.
Definitely. And the source stresses that if you have significant bad debt, creating and following a debt repayment plan needs to be a major priority.
Okay, so we've talked about managing money, borrowing money. What about when things just go wrong unexpectedly? That's where insurance comes in. The source frames it as a key way to manage financial risk.
Because life is unpredictable, right? Illnesses, accidents, property damage, unexpected death, stuff happens.
Yeah. The source presents two main approaches to dealing with these risks. You can try to avoid them.
Like driving safely, locking your doors, maybe saving extra for potential repairs.
Or you can transfer the risk.
And transferring risk is basically buying insurance. The car accident example is perfect. You pay a smaller amount of your premium regularly.
And in exchange, if a major accident happens, the insurance company covers the potentially enormous costs that would otherwise fall entirely on you.
Right. The source lists common types like medical insurance, property insurance like homeowners or renters, car insurance, and life insurance. And it defines the essential terms you really need to know.
Okay, what are those?
Your premium is your regular payment for the coverage. The deductible is the amount you have to pay out of pocket on a claim before the insurance company starts paying anything.
Got it. Deductible first.
Then a copay, which is common in medical insurance, is a fixed amount you pay per visit or service, sometimes in addition to meeting a deductible. The policy limit is the maximum amount the insurer will pay for a specific claim or maybe over the life of the policy.
Okay.
A claim is your formal request to the insurance company for payment after something happens. And the benefit is the actual payment the insurer makes on your approved claim.
So the source's big takeaway on insurance is that it's a tool to reduce your financial exposure to major negative events. It's not for making money.
Exactly. And the critical point, the best time to get insurance is before you need it. Waiting until after an event happens, it's too late.
Right, makes sense. All right, let's talk about making your money work for you and grow over time investing and planning for retirement. The source kicks us off with a really compelling story.
Yes, the story of Miguel and Jasmine. They started working at the same place. Miguel started saving just $25 a month for retirement from day one, and he saved consistently for 40 years.
Okay, $25 a month for 40 years. What about Jasmine?
Jasmine saved absolutely nothing for her first 10 years of working there. Then she started saving $50 a month, double Miguel's amount for the next 30 years.
Okay, so intuitively, you might think Jasmine would end up with more money, right? She saved double the amount for most of the time she was saving.
You'd think so. But the surprise twist the source reveals is that Miguel ended up with significantly more, about $168,000 compared to Jasmine's $147,000.
Wow, how does that work?
That difference is the incredible power of compound interest, which the source aptly calls the eighth wonder of the world.
Compounding.
Miguel's early, seemingly small contributions had decades longer for their earnings to start earning more earnings. It's exponential growth over time.
So this story just drives home the point that starting early, even with really small amounts, makes a massive difference over the long haul. Time is your biggest asset with compounding.
Absolutely crucial. And this brings us to the distinction the source makes between saving and investing.
Okay, what's the difference?
Saving is primarily for safety, easy access, and shorter-term goals, usually lower risk and therefore lower returns. Think your emergency fund or that down payment you need in a year or two.
Kept in a bank account or maybe a CD or GIC.
Right. Investing, on the other hand, is for growth over longer periods. You're accepting higher risk for the potential of higher returns. It's for medium and long-term goals like retirement.
And money in investments is generally less liquid, right?
Yeah.
Harder to access quickly without potential penalties or losses.
Exactly. This is where you use things like stocks, bonds, mutual funds, and those retirement accounts.
And the source circles back to its 5-step framework for managing savings and investments, focusing here on steps 4 and 5 after you've budgeted, built the emergency fund, and set goals.
Right. Diversify your investments, the classic don't put all your eggs in one basket. Wisdom and review and adjust your plan regularly. As your life changes, your plan might need to as well.
That diversification is directly related to the concept of risk and reward in investing, isn't it? The source explains that generally, the potential for higher returns comes with a higher potential for loss.
Absolutely. They categorize investments to illustrate this. Low risk, low return options include things like money market funds and some bonds.
Moderate risk, moderate return includes things like mutual funds and broad index funds.
Right, like those tracking the S&P 500, which historically has returned around 10% annually before inflation. Closer to 6-7% after inflation over very long periods, but that's still significant growth.
And high risk, high return.
That includes things like individual company stocks or cryptocurrencies, where the potential gains are high, but so is the potential to lose your entire investment. Much more volatile.
And the source offers a critical caution here. Make sure you have those foundational steps, solid your budget, your emergency fund, a plan for high-interest debt.
Get those sorted before you aggressively dive into investing. Trying to invest without that stable base is like, well, trying to build a skyscraper on sand. It's risky.
Good analogy. And for retirement specifically, the reason compound interest is so powerful is that incredibly long time horizon involved for most people.
Exactly. The source mentions specific retirement accounts in the U.S., like the 401k, where employers often match your contributions, which is essentially free money. You should always take that if offered. And IRAs.
And it notes that most countries have similar tax-advantaged retirement savings vehicles. The key is to identify and utilize the options available in your country. Do a little research or ask an AI maybe.
Good advice. Finally, let's cover some crucial areas for protecting your money and making smart decisions in bigger financial contexts. Things like avoiding scams, thinking about careers, taxes, and those major purchases like cars and houses. First up, the ever-present threat of scams and fraud.
Yes. The source offers 2 fundamental wisdoms here that are worth repeating constantly. Number 1, if something sounds too good to be true.
It absolutely is. The source uses the phrase, there's no such thing as a free lunch. And importantly today, they know that AI is making scams more sophisticated and harder to spot. They often play on your emotions, like fear or greed.
Yeah, be careful. And number 2, do not easily give out your personally identifiable information, PII.
Right. This includes your social security number or equivalent, your date of birth.
Yeah.
Even being mindful of using different passwords, maybe different emails for different accounts to limit exposure if one account gets compromised.
The source also includes a valuable personal caveat, though. While vigilance is necessary, being overly fearful of scams can actually lead you to miss genuine, worthwhile opportunities.
That's a good point. The challenge is finding a healthy balance between skepticism and openness. Don't let fear paralyze you.
Okay. On careers and education, the course emphasizes viewing education as a significant investment. You really need to consider the potential return on investment, the ROI.
And factor in all the costs, not just tuition, but books, fees, living expenses. For postgraduate degrees, the source highlights the concept of opportunity cost.
Which is?
The income you could have been earning if you were working full-time instead of studying. Don't just assume a higher degree automatically guarantees a higher salary. You really need to research your specific field.
And a simple but incredibly powerful tip from this section of the course. Talk to people.
Yes. Talk to graduates of programs you're considering. Talk to people working in the jobs you're interested in. Their real-world insights can save you immense amounts of money, time, and future regret compared to relying solely on brochures or websites.
Such good advice. Next up, taxes. We often only think about them once a year, maybe during tax season.
But as the source points out with the sales tax example, you're paying taxes all the time on goods and services you buy. They explain the difference between a flat tax, where everyone pays the same percentage rate, like sales tax often is,
and a progressive tax, where higher earners pay a higher percentage of their income, like income tax in many countries.
Right. For employees, income tax is typically deducted directly from your paycheck. If you're self-employed, you're responsible for calculating, reporting, and paying your own taxes, often quarterly.
The source briefly touches on deductibles, which reduce your taxable income, and tax credits, which reduce the actual amount of tax you owe, but correctly notes that tax systems are highly country-specific and complex.
Very true. Banking is another essential part of your financial life. The source explains the core business model. Banks make money primarily on the difference, the spread, between the low interest they pay depositors like you for holding your money,
and the higher interest they charge borrowers for loans.
Exactly. The source lists different types of institutions: big national or global banks, smaller regional banks, credit unions, which are nonprofit and member-owned, and online-only banks.
And each has pros and cons, right? Regarding services offered, physical branch access, the rates they offer on savings and loans, potential fees.
Yeah, online banks, for instance, often offer higher savings rates because they have lower overhead costs without physical branches, but accessing services might be different.
Common types of accounts include checking accounts for everyday transactions, usually low or no interest.
Savings and money market accounts for keeping funds accessible while earning some interest.
And CDs, or GICs, certificates of deposit guaranteed investment certificates, which offer higher interest if you agree to lock up your money for a set period. But there's usually a penalty if you need to withdraw it early.
Right. And then investment accounts are separate, used for buying assets like stocks and bonds. The source notes most people use a combination of these account types.
And it's worth reiterating which accounts benefit most from that compound interest we discussed earlier.
Definitely. Savings accounts, CDS GICs, retirement accounts, and brokerage or investment accounts, particularly over those longer time horizons where compounding really shines.
Okay. And finally, a concept that constantly erodes your money's value if you're not mindful of it: inflation.
This is simply the rate at which prices for goods and services increase over time. As prices rise, the purchasing power of your money decreases. Each dollar buys less.
So if your savings account is paying 2% interest, but the rate of inflation is 3%, the source points out that your money is actually losing 1% of its buying power each year, even though the dollar amount is going up slightly.
Exactly. You have to factor inflation into your long-term financial planning, especially with investing. Otherwise, your seemingly increasing balance is actually buying less and less over time. Your real return is lower.
Okay. The source also briefly touches on car buying, mainly to highlight that it's an area just rife with potential tricks and scams.
Yeah, they strongly recommend consulting the original material for detailed advice if you are actively looking to purchase a car. It's a whole separate deep dive, really.
Good point. And a final big topic covered is housing, specifically the perennial question: rent versus buy. The source doesn't just give a blanket answer. It walks through a detailed calculation example,
which is really helpful. They compare the effective annual costs of buying, including estimated mortgage interest after potential tax deductions, property tax, homeowners insurance, and estimated upkeep maintenance costs,
versus renting, which includes the annual rent cost plus the opportunity cost of the down payment money, what it could have earned if it were invested instead of tied up in a house.
Right. And what's fascinating is that in their specific example, even accounting for potential tax benefits, renting actually came out slightly cheaper on an annual basis. It was like $16,000 effective annual cost for renting versus $18,000 for buying in that scenario.
That numerical breakdown is a key insight because it directly challenges the common assumption that buying is always financially superior to renting.
Exactly. The source demonstrates it depends entirely on the specific numbers in your location and your situation. House prices, rent levels, interest rates, property taxes, how long you plan to stay.
While psychological factors like wanting to own a home are totally valid, the financial decision should really be rooted in a calculation like this. Run the numbers for yourself.
Wow. We really did cover a tremendous amount of ground there from that original course material.
Yeah, from the absolute fundamentals of budgeting, saving, and understanding credit, through setting goals, navigating loans, and insurance.
To the power of investing in compound interest, and finally tackling taxes, banking, and those big purchase decisions like housing.
We've essentially distilled the core foundational knowledge from that comprehensive financial literacy course for you, highlighting the key concepts and the practical takeaways.
And hopefully saved you a significant chunk of time and effort in the process. The goal was to give you the big ideas, the necessary terms, and a clearer picture of the whole landscape.
You now have a much better sense of what you don't know, which, as the source implies, is really the crucial first step towards financial mastery.
Exactly. You're now equipped with the framework and maybe the right questions to ask as you continue your learning journey and apply these concepts to your specific financial life.
So based on everything we've explored in this deep dive today, here's a thought for you to take away and maybe mull over. What is one single financial area you feel most motivated to look into further or maybe take action on right now for your own situation?
Is it finally checking your credit score and making a plan? Diving deeper into your budget, using specific tips like that per unit pricing, calculating your net worth for the first time.
Or maybe researching those specific retirement account options available where you live. What's the one thing?
Pick just one thing from this deep dive that resonated most with you. Start there. See where that single step takes you next.
Thanks so much for joining us for this deep dive into financial literacy.
Until next time.